Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. Look, we've just seen the Fed meeting coming out. I don't think we've learned anything really new from the statement itself. It was remarkably unchanged. But I think if you listen to Jay Powell and what he's been saying about the economic outlook and where we are in the economy, it's unequivocally dovish, in my opinion. The reaction in markets hasn't been too punchy, but you've got to remember that a lot of these markets were pricing in some big scenarios, specifically around a potential change to the Fed's mandate and policy objectives going forward. I think that we will see those changes play out in the September meeting, on the September 17th FOMC meeting. That is going to be a blockbuster FOMC meeting. I think we'll probably likely to see in that meeting, therefore, the long-run medium dot plot projections being taken down from 2.5% down to 2%. I think it will be married with a strong forward guidance around their policy objective that they're not going to be looking to raise rates anytime until we see unemployment back below 5%, and I think that stronger forward guidance is something that will resonate with traders as well, and that will sort of open up the door for average inflation targeting as well, and I think that's going to be a big meeting. So we will see those changes. We didn't really get any signals from this meeting and said they're in no rush to change that. I think what we've been seeing in the virus has meant that they could have had to delay that decision anyway, and that may have caused a few anxieties in markets, a bit of disappointment I suppose, but that September FOMC meeting now, where we're going to get those policy of changes, I think is going to be absolutely key going forward. But if you also have a look at what Jay Powell has said about the economy, he said that the recovery is extraordinarily uncertain, that new challenges are being faced, mostly from the fiscal side, but also from the economic projections and what's going forward. And I think the market sort of feasted off that. If you look at 5-year Treasury yields, they've traded to the lowest levels they've ever traded. We saw dollar yen trading below 105, trading sort of double bottom into sort of 104.80. We saw dollar Swiss trading to the lowest levels since 2015. I think what's really interesting there is if you look at euro dollar back above, well, poked above 118, is the ECB, the Swiss National Bank, the Bank of Japan are not going to like this one-way strength in their currencies, as is probably the case in Australia. We've got the Aussie dollar mark, pushing 72 cents at the moment. You've got the US dollar on this weakening trend, and it's not going to sit well with these foreign central banks. But what can they do? This is a dollar move, and there's not really a huge amount they can do in this kind of situation at the moment. But ultimately, the Fed are concerned about what we're seeing in the economy. Even if we see a situation where people come back to work, we see reopenings playing through, we need more fiscal support. And the concern we've got at the moment is that the Democrats and the Republicans are actually a million miles away from coming up with a resolution to pass through Congress by the expiry of a lot of these fiscal programs. That then leads through to the next week, where we actually see on the 7th of August, where we get summer recess playing through. So if there's really no resolution around fiscal stimulus then I think markets could show higher volatility. We could see greater drawdown coming through in markets. And I think the Fed have done a remarkable job to try and reassure people that they can do whatever it takes for as long as it takes, and they've really tried to reassure markets that they stand to support the reaction function in markets playing through going forward. They've also focused really heavily on what's happening in the high frequency data, and this is really important. It goes to show just how much they're looking at things like hotel occupancy rates, seated diner capacities, what's happening in credit card spending, these high frequency data points. Now they've made a connection that the falls that we've been seeing there haven't necessarily been reverberated in some of the data flow, and therefore if we're looking at the data flow going forward, you've got to look at things like the ISM manufacturing numbers that come through next week. Now we're expecting that to grow at a faster pace, but you go further out, you go into the services ISM numbers. They come out on the 6th of August. That could grow at a slightly slower pace. We start seeing the payrolls number on the 7th of August, and there are some economists that are expecting net jobs to be lost through there. If we start seeing those economics start to roll over at a time of fiscal uncertainty, you could see equity markets start rolling over. You could say that the dollar would rally, but with the extension of the dollar swap lines that we've been seeing, the extension of the repo facility, which hasn't surprised but is a big talking point amongst currency traders, it does sever the link to an extent between equity drawdown, tighter financial conditions, and that bid that comes back into the US dollar. If we do see great uncertainty picking up, the Fed effectively can supply dollars to foreign central banks, and that's a big positive for risk in itself. But that does therefore mean that the dollar doesn't get this massive bid that you'd see, and perhaps you'd be favouring the Japanese yen and the Swiss franc in that situation. And then you've got the retail sales numbers playing through on the 14th of August. But the fact that the Fed are looking at these high frequency data points that I talked about means that the market is going to probably become a little bit more sensitive to that going forward. So we're watching fiscal and the negotiations playing through because we know the Fed are. We're watching these data points playing through because we know the Fed are. If we do start seeing them roll over, Does it mean the Fed are going to have to be more capacitative? And what are we going to see through that September Fed meeting? I think when we're looking at this, the Fed have made it pretty clear that they're concerned about what's happening now in the economy, and that they're prepared to stand pat in that September meeting, or do more in that September meeting if necessarily. So some interesting situations. In terms of the dollar's underloved. It's oversold. You know, there's no doubt about that. There will be a reversal in this play at the moment, but I think dollars are there to be sold in the short term. But I think we're coming to a point where we may see a higher uncertainty playing through in markets, equities having greater capacity for higher volatility, and that may see the US dollar rally against things like the Aussie dollar, against the Kiwi dollar, the CAD, but not so much against the Japanese yen and the Swiss franc. So one to watch.